Hello guys, this will be the second option strategy video, the first being on covered call. And I would like to follow up on a covered call strategy with its cheaper alternative, which is termed as the poor man's covered call strategy. So the poor man's covered call strategy, or PMCC for short, is the cheaper alternative of the covered call strategy. Why is that the case, and why is this one of my favorite strategies to engage in? Let's talk more about that in the coming slides. So what is so good about the PMCC structure is because this trade structure allows me to have a long exposure of the underlying stock while continuing to generate short-term rental income, just like the covered call strategy. But instead of owning 100 shares of the counter, which is necessary for the covered call strategy to be of a lower risk nature, I now can have a long exposure on the stock but just at a fraction of owning the stock direct, typically at a 60 to 70% discount, and I also get to generate short-term income as well in the meantime. How fantastic is that? So how does one structure a PMCC? A PMCC actually entails getting into two options trade. One being buying a call option and the other being a seller of a call option. For the buy side, your call option should be structured with a long duration, more than 300 days, and the strike price selection should be deep in the money, where I usually reference to the 0.80 delta. For the sell side, your call option should be short duration in nature, somewhere around 30 days, and the strike price selection should be out of the money, where I usually reference to the 0.30 delta. The purpose of this trade is to gain a positive exposure to the underlying through our long call, just like buying the shares, but now at a fraction of the cost, and yet at the same point generate monthly short-term income through our sell call structure. So let's use Microsoft as an example. With the stock trading at $242, we'll buy a 1-year call option at a strike price of $185. This is a deep in the money call option, and we will separately sell a 1-month call option at a strike price of $255. This is an out of the money call option. Our $185 strike long call allow us to benefit when Microsoft price appreciates from its current price level, while our $255 short call allow us to collect a regular stream of monthly income while we wait for the price of Microsoft to appreciate. So let's take a look at a few scenarios that could happen after 1 month when the sell call expires. In scenario 1, which is the most ideal scenario, we have the share price of Microsoft appreciating from 242 to just below 255. Why is this the most ideal? Because we get to benefit from our long call increasing in value since the underlying stock increase in price. And for the short call, it actually expires worthless, which again is good for us as a seller as we get to realize the full profit potential, which is the premium we collected on day 1. Since the short call has expired, that allows us to engage in a second round of short duration call option selling to generate another round of monthly income. This time round, with the price now close to 255, we can select to sell our short duration call at a strike of 265, further increasing our upside potential for our long call. Now, what happens when the price of Microsoft appreciates from $242 to say $257, which is above our sell call strike of $255? In this scenario, your sell call strike is considered in the money, and if you take no action, it will cause an assignment where you will be shorting the shares. end result is that you will be left with your long call and negative 100 shares. But no reason to panic here. Most of the time, you can select to close off your shorted shares, book the loss, and sell a short duration call option at the same strike of 255, where the premium collected over here will likely more than offset the losses you incur from closing your shorted shares. However, instead of taking no action, what you should do is instead to roll your short call a few days before it actually expires. This means number one, buying back the short call, which is a cash outflow, followed by selling another 30 days call option, ideally at a higher strike price of 260. This is a cash inflow. And since the cash inflow from action 2 is more than the cash outflow from action 1, you still get to generate an overall net income from this row while continuing to benefit from Microsoft price increasing through your long call exposure. The third scenario is when the price appreciates too quickly over the next 1 month, when Microsoft price ends at say $280 from its current underlying price of $242 when your sell call option contract expire. Now, you can select to roll your sell call strike for another 30 days while maintaining the same strike, just like in scenario 2. However, this time round, you might not be able to generate any decent cash inflow. Like if it's only a few dollars of cash inflow, then it is better to close off the trade and move on to the next one. Closing off your PMCC means to sell your long call and to buy back your short call. The end result is that your trade is still going to be profitable, just that you are no longer able to continue riding the upside in Microsoft price. In the event that the short call has been assigned, resulting in negative 100 shares, closing off would similarly mean to sell your long call and buy back the shares you shorted. Still going to be a profitable trade at the end of the day. In summary, the key benefits of the PMCC strategy is that you can get exposure to an underlying but at a much smaller cost versus owning 100 shares of the counter. While waiting for the price of the underlying to appreciate, you can continue to generate short-term rental income from it. The key risk here is that this is not a hedge strategy. While your sell call helps to generate some income to offset the cost of your long call, if the price of the underlying falls drastically, your long call value will also decline substantially, just like a normal share ownership. For this strategy to work beautifully, the price of the underlying cannot appreciate too quickly. If not, scenario 3 will happen and you might have to exit your long call position prematurely, which will not allow you to participate in further upside movement of the underlying shares. I hope that this quick tutorial on PMCC is useful for you. I'll be following up with a real-life trade example that I took, and I also use the Think or Swim platform to illustrate some of the rolling and closing concepts mentioned over here. So do look out for that video. I will see you guys.